Hey guys, AKIL'S here. Welcome back to another Trading Edge video. Here's the deal. The markets are crap due to Friday's fundamental announcement. So instead of boring you to death and forcing trading opportunities, we're gonna do something more valuable. We're gonna break this video up into 3 parts. And the first part is actually a clip from a recent trading workshop that we did called Beat the House, where Jason Greystone is gonna teach a little bit of a lesson on probabilities, risk management, and creating your edge. So let's start there.
And this is all part of that process. If you're interested in this, well done. You've got half a chance. So having an edge in the market is simply like having a positive profit expectancy. That's it. A trader with an edge will make money over time, as long as they give the edge long enough time to play out. Make sense? And there's 4 core methods that we can use as traders to increase our edge. So take note of these, right? The first one is increase your win rate, right? This is how we beat the casino, by the way, guys. This is how you beat the house. First one, increase win rate. Second one, decrease loss rate. Third one, increase profit on winning trades. Fourth one, decrease losses on losing trades. Okay? So in other words, you want to win more than you lose in terms of you're right more than you're wrong. And you want to win more on the winning trades than you lose on the losing trades. I know that sounds very, very obvious, but does everyone understand that they are 4 separate things that you can increase and work on to develop an edge and refine an edge? Because edges in the market are very small. Edges everywhere in business and everywhere in life are very, very small. I'm going to prove that to you in just a moment. So we must exploit all of these things. Okay, there's a saying in the financial markets, cut your losses short, let your profits run. Who's heard it? It refers specifically to, points 3 and 4 on your screen there. And that helps traders increase their edge. So a powerful trading strategy, which we're going to go through a bit tomorrow, with stringent risk management procedures, should use all 4 of these methods in order to increase your edge in the market. So here's a question for you guys, right? If all you need to do to make money is to follow a good strategy, then why doesn't everyone make money trading? Anyone? Brings me to my next point, which is risk preference. One of the reasons that people find it so difficult to stick to their trading strategy is because the human mind is not wired to think in terms of probability. Instead, what it's designed to think of is in terms of survival and self-preservation. It is literally basic human nature to prefer immediate gratification over delayed gratification. But the problem with that is, if you employ those instincts in the market, that is a sure way to lose your money. That is when you become a gambler. That is when you're using emotion to trade. And the only logical part of your brain you're using is to give you logical reasoning as to why you emotionally got involved in that gamble or that trade. Who's lost money in gambling before and then tried to make it back, or tried to persuade themselves that why they should be getting into a bet or a gamble right? So your emotion's driving it, and then your logic is trying to back up your emotion, which is that's not the right way to do it, right? So let me demonstrate this to you with a bit of a survey, okay? Here's a question for you guys. Would you prefer a definite gain of $700, a sure gain of $700, or a 75% chance of gaining 1,000 and a 25% chance of gaining nothing? We've got mixed, see? We've got mixed people here, right? A for sure, A, B, 700, A. Right, I can tell you that on this actual survey, 84% of people chose option A. Because they tend to be risk avoiding when it comes to gains, preferring to hold on to the, bird in the hand, right? Once they have something, they're violently opposed to risk losing it. Sound familiar? Now, let's try another one. Would you prefer a sure loss of $700 or a 75% chance of losing $1,000 and a 25% chance of losing nothing? D, right? So this is, yeah, it's still majority D. 87% of people chose D because they tend to be risk-seeking when it comes to losses, right? They'd rather risk a possible big loss in preference to suffering a certain moderate loss. And this is how gamblers get hooked. Once they've made a loss, they keep gambling, sometimes even bigger stakes, larger stakes, because they're trying to avoid realizing a loss. Does that make sense? So they keep gambling so that they feel like they're still in the game, even though they're losing money. So it becomes irrational. Because they're still gambling money, they still haven't given up, quote unquote, which means they're not losing in their head. Does that make sense to everyone? It's crazy, right? It's irrational, completely irrational. But that's what happens. That's what an addiction is. Now you know how to calculate probabilities. You'll find that options B and C here, all right, the two middle ones, they are mathematically better decisions. But the hard part, specifically in this example, is retraining your subconscious mind to recognize that that is better decisions and then start taking actions in line with probability, because it goes against how you're built as a human. Naturally, this comes with like time and experience, right? And these principles that I'm sharing here, they're not exclusive to trading. In fact, many successful entrepreneurs and businesses use this structured thought process in their decision-making processes every day. I'm sure there's great entrepreneurs in here who have done exactly that. Cool. Was that valuable so far? We're going to talk about luck now. We're basically ironing out everything to do with probability and edge development at an early stage so that you guys have got real clarity and focus and determination to succeed on this. If I can give you confidence at an early stage of this workshop, by the end of it, you're going to take in the information with an open mind, you're going to have an objective mind, and you're going to be able to develop on what we teach you rather than, have your finger in the sky.
Now, real quick, before we move on to part 2, I want to remind you guys the full recordings of this workshop are available until the end of August. Time is running out, so do not waste it. I'll put a link in the show notes below, but make sure you check it out. It's 4 days of greatness. Take my advice, get started sooner than later because you will run out of time. Now, what I want to do next, I want to practically apply that lesson to the markets. And if you watched the midweek video that I put out earlier in the week, we were looking at the dollar peso at a trading opportunity and talking a little bit about picking targets. Now, this is going to be that same trading opportunity, but this time we're going to look at it from an active trade management perspective and talk about how we can use the tools of active trade management to reduce our risk and ultimately increase our edge over time. Here's what I would personally do. From a risk management perspective, I actively manage my trades based off of structure, and this is a good example of taking how analysis plays a general role, right? So we're coming to a previous level of structure. We're at a previous level of structure. I don't know if we broke it already. We might have. Give me a second here. 1910. Okay, so if we break and close above this previous level of structure, what should that tell us? That we're likely to continue higher. If we're likely to continue higher, where shouldn't price return to? Where should price not return to? That's a tougher question, right? We shouldn't go past this level if we're going to continue higher. We may retrace back to it, but if we violate this level, we're probably wrong. So this is where I would take my stop loss wherever it's at from here. My entry is right here. We no longer need it to be down here for protection, right? Originally it was here because this was our protection, this structure level. With this being our new relevant structure level for protection, we can trail it. And what do we do when we trail it? We take our risk from whatever it was, let's say this, and now all of a sudden, depending on your trailing method, maybe it's break even, maybe it's a little bit below, but it's much better than the original, right? So now look at the risk that we have on the table. If you guys remember from the workshop, we talked about creating your edge, right? We're not creating, well, I guess we talked about creating your edge, but also kind of continuing to develop your edge. And we talked about 4 ways you can do it, right? Remember the 4 ways you can do it? 1, win more. Increase your win percentage. Become better at making predictions and win more of the time. 2, lose less. That's kind of the same thing because I guess when you win more, you automatically lose less. So lose less of the time. 1 or 3, too many numbers. Increase your average win. When you win more. That has to do with like maximizing targets, getting the most out of the trade that you can without getting too greedy and giving it back to the market. And who remembers the 4th way? Who can tell me numero 4 or cuatro, since we're on the peso? What's the 4th way? Win more, lose less, win more when you win. Really? There we go. I'm like, is my mic off? Losing less. Thank you, Len. Yeah, losing less when we lose. Decreasing our average loss. What is a great tactic for decreasing your average loss? Implementing an active trade management routine. Because now we just took our loss from here to here. So even if this trade loses, we don't lose as much as we originally intended to lose. Which some of you guys are like, oh, Akil, it's still a loss. But no, that allows us to capture more on our next win. Because if we had a single win, if we had a loss that looked like this, I really got to get rid of this sticky mouse. This is irritating me. If we had a loss that looked like that and a win that looked like that, everything in this open area is profit. If we decrease that loss and we put it down some, everything in this area is profit. See how we have more profit? Yep. So trade is going in the direction. That is good news. Now, I'm not saying to do this. This isn't one of those things like we discussed earlier where you write it in your rules right away and now you can do it. This is something that you got to test, because if you trail too close, you're not going to give enough breathing room for the market to kind of ebb and flow. And then you're actually going to hurt your win percentage or hurt your average win, right? But this is something that you test. Or if you're someone that has already been trading a strategy, this is how it worked for me. I was actually already trading my strategies first, and I added this second. I started testing this after I already had a tradable plan, and it made it better. So that's another option. So good stuff. Now don't look at it, because the more we look at it, the less chance price has of going up. So let's switch to something else. How's good old Euro Swiss doing? Oh, we got our pullback from earlier. Look at that. All right, so part 3. I want to come back and review this one more time and take a realistic look at the continuation of the active trade management. If you guys remember, we started right here. I'm assuming our targets, I haven't touched this chart since we did the live room. I'm assuming the trader was looking for targets up here, and you can see that we just missed it. Now, there's 2 ways of looking at this, right? You can be the realistic trader or the hindsight trader. Of course, the hindsight trader is going to be like, oh, I should have took targets right at the top before it reversed. that doesn't actually benefit you in the market. What you want to do as a realistic trader is maybe if you see the market reversing here, you ask yourself why? How come we didn't get a little bit higher? How come we turned around right here? And that could leave clues that you can use for the future. Or sometimes it's just dumb luck, right? The markets, I said this in the 51 Trading Rule podcast, right? The markets just do what they want when they want, and it's not always fair. Boo-hoo, get over it, that's life. But going back to trailing stops, for example, right, to see how it helps us here. Remember, our initial stop loss was down here somewhere. We talked about as we created new structure. Whoa, I'm all over the place with my mouse. Whoop. Up here, what we can do is we can take that stop loss and we can roll it up, reducing our stop loss or our risk to either a little bit or even to break even. And then you can see that we do it again once here. After we get to this level right here, we get this nice little rejection candle right at a previous level of structure. Look left, structure leaves clues, perhaps a good target one area. We retrace a little bit, a really brief kind of move, and then we once again violate to that to the upside, giving us a new structure high right here. This provides another opportunity to roll our stop loss. So in a situation like this, I'll show you how that active trade management helps us out, right? You can see that we didn't get to our targets, which stinks because it was close, but it is what it is. So now you're in a position where price action may come all the way down and you may have been up, what we're up here, 65 pips or so, and then come all the way back down to get stopped out for a break even or even for a loss, which is something you don't want to do. However, with trailing, what you would have been is you would have been stopped out right here for about 30 something pips. Now, 30 something pips isn't the full win, yes, but it's better than taking a loss. It's better than break even. This also gives you one more opportunity as price action comes back to this previous level of structure. Because we didn't fulfill, or if we didn't get to a level where we fulfilled your target, I would call this close enough in my opinion, but just for trading example purposes, this also gives you an opportunity to get involved. So if your analysis still tells you that, hey, I think price is likely to go up, we've come back to a previous level of structure, right? This is the neckline of a head and shoulders. This just provides a secondary opportunity at getting involved in the trade. Now, very important, this secondary opportunity isn't a revenge opportunity. You don't get involved just because you didn't meet full profits on the first one. This has to be its own independent new analysis. And you want to make sure you distinguish between that, because when the emotions get all hot and heavy and we're all riled up and we're greedy or we want revenge, emotions cause us to do a lot of dumb things. We've seen it before in the markets. We've seen it before in personal life. I won't give you those stories because they're pretty embarrassing, but hope you guys enjoyed the lesson. If you have any questions or comments, leave them below. Remember, check out that workshop before the recordings are gone. I got to keep reminding you because every time we do this, people get to us late and they get upset when we tell them sorry. So make sure you watch them. Make sure you check out the Trading Coach podcast, available on your favorite platform 3 times a week. And until next time, plan your trade your plan. Take care. Hope Everton can pull it off against Spurs today. We're missing 7 players and our entire defensive line, and Spurs is very offensive, but maybe. That's why I'm trying to get this video out before my mood has changed. All right, see ya.
I want to be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on. This is